Welcome to the Yoked Podcast, where we talk about all things entrepreneurship, real estate, and partnerships. I'm your host, Travis Hall, alongside my co-host and wife, Ingrid. Together, we've been in real estate for nearly 2 decades, always as an equally yoked husband and wife team.
Join us each week as we bring you a new episode. And as always, be sure to like, subscribe, follow along, and welcome to this week's episode of
The Yoked Podcast. What's up, and welcome back to The Yoke. I'm Travis.
And I'm Ingrid. And today we are breaking down one of the biggest real estate opportunities we've seen in a while.
The big, beautiful tax spending bill, or whatever they're calling it.
Debt bill. No.
Exactly. It is a unique time for us as real estate investors. And so we figured, there's a lot of talk about it. And so let's dive in. This is not a political post or a podcast. We're not going to go into that. We're going to go into specifics about real estate.
Yeah. And it's one of our first episodes. Well, it's the first episode we are recording here in Coeur d'Alene. We've officially made the move. Over the last month, we did a podcast series about big decisions, bold moves. We've moved our family north. I can't say across the country, but far north.
Across the country north.
Yes.
1,000 miles.
And so it's been a little bit since we kind of dove back into real estate on the podcast. And so we're excited.
I feel like I have a guest in a guest, audience in person. Here you are again.
Right, here I am.
It's been a little bit. So we get Ingrid back today.
Yeah.
Your wise wisdom.
And I think we should give the people what they want, like a quick life update. What are just like a few things from the last month that have been amazing?
Well, the lake is amazing.
It is amazing.
So we're situated, for all of you that don't know, Coeur d'Alene is on this beautiful, unbelievable lake called Lake Coeur d'Alene. And it's just been so fun. I mean, the last 2 nights after dinner, we rode our bikes down to the lake and just played.
Yes.
And it is crystal clear water. It's beautiful, mountains everywhere. It's pretty dreamy.
Yeah, it's been amazing.
Which is why we came.
Yeah, absolutely.
And it's very calm and laid back. My good buddy joked me the other day, he's been here and he's like, I feel like it's like Mayberry from like Andy Griffith. Yes. I was like, I get that. Like where we're at, it feels very small. It's like very small with all of the nice high-end things. Like there's a lot of nice coffee shops and breweries and restaurants downtown. And there's all the main things that you could ask for just north. And so it's this unique little spot.
Yeah, it's been wonderful, honestly.
Yeah, it has. It's been fun. So go ahead.
Well, before we dive in, I do have to give a caveat that, and like you said, this is not a political podcast by any stretch. Anybody who knows us personally knows we're probably about as purple as they come. I will say that anytime you have big legislation that goes into place, whether it's local or nationwide, like we've just seen, it is really important as an investor to be able to pivot and take advantage of whatever is being given to you, right?
Correct.
And so we've been in a really hard 3 years in the real estate market as investors, as brokers, agents. I mean, STR numbers are down like across the board. Our industry's taken a huge hit over the last 3 years.
I mean, since like July of 2022.
Yeah. And I mean, just broker wise, so people know, like our industry shrank by half. So it's not, you're self-employed. It's not the same as layoffs, right? But I mean, to have half of the brokers in the US no longer be brokering it's a big deal. And so sometimes though, legislation goes into place or a bill like this, where it's nice for an investor to be able to take advantage of. And so caveat being, we know that the bill is not perfect and there are a lot of things that we wish were different, but at the end of the day, our job is to steward gifts that are given to us. And there are some hidden gifts as real estate investors in here.
It was a game changer in a few little aspects. And so today we're just talking high level.
High level.
Yep. And then next week we'll talk a little bit more detailed.
Yes. So kind of 2-part, but today we're going to talk specifically about cost segregation. And we have notes because we want to get this right.
Yeah, this is like a detailed one, so we don't want to go off too much.
Yeah. And so why don't you start just by telling everybody kind of what's in the bill and some of those advantageous items?
Well, there's a ton in the bill and a ton that we're not going to go into that are not related to real estate.
Sure.
Like stuff on tips and Social Security and salt and all of the things that they're important pieces, but not in this lens.
Yeah.
And so for the bill for this lens, I think the biggest one, by far, is that bonus depreciation is back full at 100%. This past year, it had dropped down to 60%. And so we're going to dive into that a little bit of what that is for those of you that don't know, but it is a big, big, big one. Mm-hmm. And then there's some LLC structuring, not LLC, but entity structuring. That is a big one as well. Then
there's some mortgage interest breaks.
Yep.
Again, we won't go specifically into those because it's not like an investor specific lens for the cost seg, but important for you to know.
Yep. And then one of my favorite that should be your favorite as well is the new reporting on 1099.
Yes, I saw that. I was like, praise God.
It's like a goofy one, but
from 600 to 2,000, right?
600 to 2,000.
Praise Jesus for all of us small business owners that have been racking our heads every January
to submit all the 1099s, and you're like, oh my gosh.
Yes.
It's so much work.
Gosh, I know.
But there are a few little things like that. But again, today, we really want to go into cost segregation because it is one, even in our world, in real estate, a lot of people don't know what it is. I had a conversation just the other day, and that's part of why we're like, let's do this podcast.
Yeah.
I had a listing back in Denver that I was talking with an agent on, and I was like, yeah, with the new spending bill, and it really does affect if your person's buying it as an investment property. And she's like, I don't really understand what you're talking about. Like, I saw the bill, but how does it affect me? And she joked me. She's like, I've been in this industry for 30 years and I should definitely know more about this, but clearly I need to educate myself. And so we talked all through about like cost segregation and how it could be a benefit to her clients. And so it really just led us to like, hey, let's talk about this because as an investor, and this is an investment lens, right? But for everyone that owns anything in real estate or wants to, like, you should know at least that this is available to you.
And for brokers helping your clients, right? I mean, we have some properties that are great opportunities for second homes. This is a huge deal for brokers who are having trouble moving properties where they fit into this category because it could be a very big selling point, especially in some of the higher price points where really, there's multiple ways, we've talked a lot about this, that people buy real estate, but one of them is tax benefits. And this is exactly that.
Absolutely. And I mean, it doesn't just affect real estate, this cost segregation and more bonus depreciation. And people use it for, business vehicles and all kinds of large equipment and assets. But again, this lens is how do we use it as investors and what is it?
Yeah.
So let's deep dive into a cost segregation study. And again, we should caveat that we are not tax professionals.
No, or attorneys.
We have to say that.
But anything else where we could possibly get sued for advice we give. Always consult your tax professional. This isn't advice.
This is just us talking.
Yes.
But we do what we're going to say.
Yeah.
I should say that. Like we have done it multiple times and we do actively do it. And, it's for a reason.
Yeah.
So, all right, let's talk about depreciation and cost segregation. And so
it was at 60%. It's up to 100 now.
Yeah.
What is it? And what does that mean?
Exactly. So what is at 100%? And that is the bonus depreciation.
Yes.
And so there's two different things. There's the bonus depreciation that's in the tax bill. And the way to use the bonus depreciation in real estate for investment purposes is you have to do what's called a cost segregation. And so let's kind of break those down. So if you buy a traditional property, or any property, you buy a property and everyone's pretty familiar with traditional depreciation. Easy math, you buy a $275,000 property. It's a residential property under four units or under, and you depreciate it over 27.5 years. That's
what a funny number.
Why? I have no idea. But that is how, according to the IRS, that's how long you can depreciate it. So basically, again, easy math, you can depreciate $10,000 a year, right? And so now with a cost segregation and the bonus depreciation, you can break down that property into buckets versus just one depreciation bucket.
Because whose washer and dryer lasts 27 and a half years?
Correct.
No person's washer and dryer lasts that long.
And so with the cost segregation, it breaks it into multiple buckets. And those buckets are 5-year, 7-year, 15-year, and then your standard depreciation, 27 and a half years. And so now that it's 100%, anything that's in the 5-year, 7-year, and 15-year category, you can now accelerate that depreciation and depreciate all of that, 100% of it, in the first year. And so that's why it's so crazy. And so again, like a real life example, I think examples help.
Yes.
And so I printed off a good example that I created. So I'd show you, but not everybody's watching. And so let's take a property that is $400,000. Maybe low if you're in the Denver metro, but it's 400 grand. Out of that, you cannot depreciate the land. And so the land, let's say in this example, is worth $50,000. So take that off. The depreciable amount of property is $350,000, 350. And so in a traditional way, doing it 27 and a half years, you basically get almost $13,000 a year, which is still awesome. I mean, that by itself is just amazing. If you did a cost segregation, which means that you hire a third-party company to come out, this is not a DIY thing.
Let's talk specific. Let's pause there and tell everybody, like, specifically, how do you go about finding a company that can do a cost segregation study?
Right. And so some people might say it's DIY, you might be able to, but you have to prove, and like it is a very detailed report where they look at every single thing. They
count your outlets.
Yep, outlets. They count cabinet pulls. They count cabinets. They look at everything. And then doing that full detailed analysis on your property, they break it all up into chunks.
Yes.
And so, what you do is you hire a cost segregation person or company, and there are multiple out there. There are some that are less expensive that they don't fly out. We've done both. We've had some where they fly out and they're on site all day, like tallying.
Yep.
It'd be such a boring job to me, but
I actually think it'd be methodical and maybe enjoyable, like stocking shelves at a grocery store.
Right. And there is companies that's virtual. And so we've used those as well. And so they hire you, you take a video of everything and then upload the recording to them. They ask to see specifics. It's a lot quicker, but then they have the video and so they can go back and count.
And that's cheaper.
And that is cheaper.
Yeah.
But you pay somebody to do it and build your report. And then based on that report, you have as proof of, hey, here is how we arrived at our number. And then you give your report to your CPA and they do the cost segregation, for the depreciation. But
back to the example.
Yeah, back to the example. So $400,000 house, 50 grand off, it's $350,000 total. In a cost segregation with the bonus that we have now, let's assume that there's $80,000 in the 5-year property bucket. And that is like flooring, appliances, lighting, stuff like that, right? There's $20,000 in the 15-year land improvements. So like your driveway, landscaping, stuff like that. And then $250,000 remains in just the normal depreciation. So a big chunk.
Drywall,
right?
The actual structure of your home.
Exactly. And so with that, there's $100,000 in the 15 and 5-year, right? In that little bucket, 15.75, however it works out. And so basically what that means is you can take the $100,000 as a first year depreciation against your active income. And this is where it gets even trickier and more of a blessing, depending on your status or what the property is. If it's a short-term property, like a Airbnb, there is ways that it can go against your active income. There are rules. You have to materially participate, or you have to be a real estate professional, tax status. But even if you're not, it goes against your passive income. And if you don't use all that 100, it kicks for indefinite. Like you get to use it for forever.
So good example of that would be a short-term rental we have in Grand Lake. When we purchased it, we did this a few years ago. We are designated real estate professionals. Bonus depreciation was taken in a partnership, so half and half, and then treated separately on your pass-through kind of K1 when you file your taxes. And we were able to take that against our active income. We W-2 ourselves through our own company. Anything we made in commissions, property management, anything like that. And our partners could take it against their income. They couldn't take it on 1 year. And so it filters down basically to the next year and the next year and the next year. So it does benefit you, even if you're not a designated real estate professional. It can just be done in a different way.
Exactly. And so like to tie a bow on like that example, in the first year example, because you still get to use the 27.5 year depreciation, right? You get to do both. It's still all the same math. It's just front loaded
when you get to do it.
And so in this example, in the first year, instead of having nearly a $13,000 depreciation, you get $110,000 of depreciation. So nearly 10x from just straight line, which is just insane. And so year 2 to 27, technically your depreciation is a little bit less. It's about $3,000 less than what your normal was. Yeah. And so there's a lot more effort and involvement in order to do it. But this single thing is one of the ways that so many people that invest in real estate eliminate their taxes for the year. Yeah. They buy a large piece of property that they can depreciate and then do a cost segregation and then do bonus depreciation, and it wipes out all of their active income.
And I would say too, like, just to offer some encouragement in the market, right? Like, it has been dismal. And honestly, this is a way to incentivize especially high earning investors to put a cash infusion back into the real estate market. And so
we will see it.
There will be cash that will enter the market because specifically of this. And that's important to remember because it does affect all of us. I mean, as an economy as a whole, you absolutely will see that over the next few years because of this specific part of that bill.
Yep, absolutely. It is a gift to the investors of a lot of different ways, but this specifically, we're going to see more people invest solely because this is back. It was here a few years ago. We saw a lot of people buying solely because of that, and it's been tailoring off. Yes. And it's back.
Let's talk about just real quick, like what happens when you've taken that bonus depreciation and then, something happens, another opportunity is available and you have to sell that before all of that is taken. Like, what does that recapture look like?
Yeah, good question. So, that's for sure a CPA question based on how do you just take that money and put it in your pocket? Are you reinvesting it in something else via like a 1031 exchange? All of those things matter. Yeah, I mean, if you immediately sell it, then we got to recapture some of that depreciation that you just took because you didn't hold it the life of the depreciation of the property. And so you got to recapture or reinvest it somewhere else.
And I feel like for a lot of people who are maybe new to investing or they haven't done this yet, really a lot of these decisions, remember to make them when you purchase the property. So often we think of, okay, well, we'll deal with the taxes, right? When I get that big net check at the end. No. It matters very, very much how the property is treated when you purchase it. So definitely be consulting somebody now, not when you go to realize all those gains.
Yep. Well, and I think we'll see a lot more people buy properties and like short-term rentals. I see with that loophole, it's called the short-term rental loophole. And now partner with cost segregation and bonus depreciation. I think we'll see the more savvy investors buy up some more short-terms this year.
For sure.
Just solely based on that.
Yeah.
Because it can turn a relatively negative cash flowing asset into net positive when you factor in the tax savings.
Yeah, your cash on cash ROI increases immediately. And so again, I go back to and we'll talk about this next week, like specific ways that we're going to be looking at evaluating investments because of this bill. Yep. But one of those is like a property that didn't necessarily look very appealing 2 months ago when it was brought to you could be extremely appealing now.
Right. And I mean, it's important to note, like, it's not like all of a sudden it's just this giant change because it was still available.
Yep.
But 60% versus 100% is very different.
Yeah.
And so that's why it's such a big thing now is that, wow, I mean, you're getting 100%, not just 60% of it. So
can you, and I am asking this because I really don't know, can you backdate that? Is it just properties that were purchased this year in 2025?
Good question. I don't know with the specific bill. As far as a general statement, you can retroact.
Right? That's what I thought.
But I don't know. I doubt for the tax bill. Like I said, I thought about it for property from last year.
Right.
And so I don't think they will go retroact because last year's tax bill said it was 60%.
Got it.
But in general, like
even if you haven't filed taxes.
Yeah, right. So you can still definitely do it. But like if we bought a property in the beginning of this year, and the taxable hasn't gone into effect until now, we can definitely do it for this year.
Yeah, because it's the tax year.
Correct.
Got it. All right.
But I did have that thought as well.
Right?
I'm like, I wonder.
Well, let's wrap up. I'm going to put a little scripture in here.
Yeah, absolutely.
Luke 12:48, to whom much is given, much is required. And
Amen.
This is a great example of what do you do with the knowledge that you have, right? What do you do with the circumstances you've been given? Whether you love the administration or you hate the administration, at the end of the day, the bill has been passed.
Correct.
And so what are you going to do with it? And to anybody out there, like you have an obligation. I would say that is stewardship, is to go use the information and the gifts to make a better world for everybody.
Absolutely. It's not, I mean, most of our audience is people that are interested in investing of some kind.
Yes.
And so obviously we know who we're talking to right now, but this isn't about being a gazillionaire
or a pro investor.
No, it's not. It's about being intentional. And to what you just said, it's about, kind of being a steward of what you have right now. And this is what you have. And so, it won't always be here. It will change, but it's kind of like a seize the moment kind of time.
Yeah.
Amongst like a time where it is a little wild. And if you turn on the news, it's scary. And so this is more of a truth in regard to this lens of the bill.
I love that.
I love that too. Well, next week's going to be fun because we are going to break down a little bit more details of what Ingrid and I are planning on doing
with this information. So how can people find you on the socials?
Yep. So they can find me at Instagram, or all the socials really, but Instagram's the main one, at the Travis Hall, or our website, partnerwithnorth.com.
Yes. And you can find me at the Ingrid Hall on Instagram, and be sure to like, subscribe, send this episode to somebody who's looking to build wealth through real estate, and tune in next week.
And if you want any of our show notes on this one, just comment cost segregation and we will send you those, our little downloadable cheat sheet that we have.
Awesome.
Cool. Well, see you next week. Thanks for listening. Thank you so much for listening to this week's episode of the Yoked Podcast. We hope you enjoyed it.
And as always, be sure to like, subscribe, and follow along as we drop a new episode each week.